Hey, Mad Money fans, check the bottom of your screen for an exclusive offer. Next.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Hope you're one of my friends. I'm just trying to save you a little money. My job is not just to entertain, but to put days like today into context, because you need that. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. The sense of capitulation is so thick, you could cut it with a dull plastic knife. Buyers, they vanish. Sellers keep dumping the same stocks because they've decided that if you can't beat the bond market, well, you might as well join it. Right now, from looks of things, you can't beat the bonds. They're too all-powerful. And that's how you get a day where the Dow tumbles 388 points, the S&P plunges 1.47%, and the Nasdaq plummets 1.57%. What a hideous session, at least for the bulls. What does it mean to be able to not beat the bonds? Look, the bond market is gigantic, much bigger than the stock market. Most people don't realize that. When interest rates go relentlessly higher as they have this year, at each level, each pivot, more people lose interest in stocks, and we're seeing that again right now. When you lose interest, this is what you do pretty much every day in this miserable month of September. When this market becomes emotional, I like to be clinical. So why don't we do this? Let's get into the minds of the sellers, who, by the way, have ample motivations for their actions, not disagreeing. First, these myriad sellers know that interest rates have gone from exceedingly low to, well, much higher. You can earn 4.55% risk-free. Now, if you buy the 10-year Treasury, you can earn 4.87% with the 20-year. Hey, that's much better than it was a year ago. These yields are going high for three reasons. First, the Fed has not been able to fully get inflation under control, and their endless tightenings haven't yet done much damage to the economy, meaning they have every incentive to keep tightening. Where are the bankruptcies? Where are the huge layoffs? Where's the peak in housing? Not yet, says Mr. Powell. Second, over the past few years, the federal government's authorized colossal amounts of spending that needs to be financed with massive bond issuance. And they don't care what kind of price they get for their bonds. They've got to pay the bills. Third, the Federal Reserve itself owns $8 trillion in total assets, down from a peak of around $9 trillion last spring. But it owned just $4 trillion worth before the pandemic. The government and the Fed motivated sellers. The Fed selling their bonds is another way they can crack down on inflation, by the way, and they seem to reload at every opportunity. These three reasons have crushed anyone who gets in the way of the bond market, making potential buyers skittish because every single time they buy, they get their heads handed to them. So the buyers of treasuries are now on strike, which is how the treasury yields could go up so much in the last 48 hours. Remember, when prices go down, yields go higher. What does any of this have to do with the stock market, you're probably asking? Look at it this way. First, why own stocks when you can make north of 4.5% risk-free from the 10-year? 10-year Treasury is like a great dividend stock that's guaranteed not to lose your money over the next decade. That's the real strong competition to any stock, isn't it? Second, financing costs are soaring for those who use credit cards, not a mortgage, or want to buy a car. That's problematic. Third, corporate profits are probably headed lower because interest rates are a huge part of the cost of doing business. So higher financing costs really hurt for the vast majority of companies and their clients. Who wants to own a stock where the earnings estimates are probably going to come down? Of course, and this is forgotten, if the Fed can get inflation under control, that would bring buyers into treasuries, sending their yields down and causing money to flow back into the stock market. Plus, if you think stocks have gotten oversold versus bonds as an asset class, you might want to be a buyer, and stocks have come down pretty hard lately. But even if the Fed can't beat inflation anytime soon, there are reasons to own stocks. More than three. First, plenty of companies can actually do well in this environment. You're going to hear from two of them later in the show, outrunning both inflation and higher Treasury yields. There have been many times in history where rates went relentlessly higher, and you can still make money in stocks. Most of these occurred in the 80s and 90s, but they did occur. I remember I was running money myself. I killed it buying stocks when everyone else was running away from them in both periods like now. Buying anything seemed crazy when I bought them, but it was the right call. Second, many stocks have come far down more than they should relative to Treasury yields. Now, that's subjective, but if a company can still make money in a higher rate environment, then maybe you need to buy the stock right here. Capitulation breeds buying opportunities. Always has, always will. Not a cliche, but truth. Third, maybe a 4.5% risk-free doesn't cut it for you. Or maybe a 4.7 doesn't. Maybe you want more. Maybe there are stocks that are worth owning, even if you could get 5% from the 10-year. You know something? Today I saw that Denny's, the restaurant chain, commemorated a booth where NVIDIA's Jensen Huang would hang out when he co-created a company that's now worth $1 trillion. I don't want to find more tenures. I want to find you more NVIDIAs. I don't want to run in place. I want to make more money than the tenures offering. It's possible? Of course it is. Hey, maybe we just need to find the next booth. Finally, what happens if the Fed really gets under control, gets inflation under control? What happens? Well, then you could argue that short rates would be too high. Sure, it may not mean that the 20-year or the 10-year will go down that much in yield, but the short rates would, as there'd be no reason for the Fed to keep them high. More important, go back to that Denny's booth, will you? As long as inflation's raging, even if you find the next NVIDIA, you might not want to own it, because something like NVIDIA stock trades on future earnings many years down the road, and inflation erodes the value of those future dollars. But you definitely want it if inflation is under control. Now, there are so many darn cross currents right now, it's hard to keep your eye on the prize. I mean, there's a president who joins the picket line, first time in history. He's not trying to help negotiate a deal between the UAW and the Big Three. He's trying to beat the Big Three, asking them to pay people a lot more, while they also need to spend fortunes to pivot to electric vehicles. We got the FTC and the Justice Department gunning for the mega caps. Chair of the FTC, Lena Khan, has hated Amazon for years. Wrote a review article about how Amazon's got monopolistic ways. She did that when she was in law school. When she was appointed by President Biden, though, you had to presume she'd bring the suit. She's against any company she regards as too big, even though that's not really a legal standard. Justice Department's grilling Apple's Eddie Q about how come they decided to give consumers the best default search engine with Google. Can you imagine if Apple used Bing? Joke. Apple cared enough to give you the very best. What would the government give you? So we have a government that's less interested in companies doing well than any other time I can recall in my career. No wonder we're paying less for their earnings. But I want to make something real clear. There's always a place where interest rates stop going up because bond buyers are found. Inflation does get destroyed in the end. Stocks eventually reflect more than the worst after we get a capitulation. And that is the only surety. We don't know if that's happening now or at the next level, 4.75 for the 10-year and 5% for the 20, or the next level after that, 5 for the 10-year, 5.25 for the 20-year. But hey, 5.25, 5.5. I got 5 and 6. I got 6. Okay, we don't know. However, at some point it will be reached. We can't just ignore that, which means you need to buy some stocks here, not sell them. Just don't do it all at once. Do it at a scale, some here, some lower, because if the Treasury yields do go to those levels, you want enough cash left over to buy more stock. We're oversold enough now to justify it, if not just insist that something be bought. Well, I mean, what could be more painful? Well, that's what I like. I'm not a masochist. I just like to buy pain. Bottom line, you buy stocks when you're trying to get rich. You buy treasuries to stay rich. I think a mix of both is fine. But if you go all bonds now, I now think you're liable to miss something real good in stocks, even as that seems downright impossible. It always seems that way. It never is. Ken in Illinois. Ken.
Good day, Dr. Cramer. I'm a second-time caller from Central Illinois.
Excellent. Good to have you on the show.
I have a small position in ELF stock, ELF.
Mm-hmm.
It's pulled back significantly since mid-September, though, perhaps due to many large insider sales. Do you feel that ELF stock is still a buy?
I happen to think the world of ELF. I think it's doing incredibly well. But I will say this. ELF stock is up 97%. That's not what you buy when the market is getting killed. A stock up 97% is a candidate for sale, not buy, even if it's terrific. Let's go to Dodd in Georgia. Dodd.
Booyah, Jimmy Chill.
Hey, man, how you doing?
Good. Long time, first time.
Okay.
Jim, I've invested in this company for so long, I honestly cannot remember if it was a result of your influence or not. It has certainly been a big winner for me. I know we avoid and or ditch companies with accounting problems, but what do you think about some of the current hullabaloo around Axon?
Ever since I recommended this stock, which, by the way, when the stock was about 17, there has been hullabaloo about Axon. And that hasn't changed. As a matter of fact, that's probably the only constant about Axon, other than the fact that its stock goes higher. Ann in Indiana. Ann.
Hi, Jim. We're having our first rain in 6 weeks out here.
Well, I'll send you some rain. I got plenty of it. What's happening?
So after reading, I'm a Grateful Club member, by the way. Forgot to tell you that. So there was an article last week in the Wall Street Journal about Estee Lauder, and I'm wondering, with these Chinese regulations on cosmetic imports, Do you feel that's already baked into the stock, or are things worse than I thought?
Okay, I was pretty candid this morning at the 10:20, and again at the at our 2-ish that we do after 2 o'clock, that you can't own it yet. Estee Lauder's going to have a horrible quarter, and I can't buy it ahead of a horrible quarter. Once that happens, then I could be interested, but it is probably going to be horrible. And that's a shame, but it's the truth, so we're holding back buy. Let's go to Ken in Oregon. Ken.
Is there a chill man in the house?
Yeah, I'm ready for you. What's going on?
Okay. My question is about Bolero. After your last interview, I picked some up. It's gone down, stayed down. Is it down for the count? Buy, sell, or hold?
Okay, Bolero's not doing as well as a lot of people thought. Therefore, it's still doing, it's still probably going to go lower, but there is fundamental value to a bowling alley chain. I just can't find out where that is, but it is a SPAC, and a lot of those are still going lower just because they're guilt by association. Okay, treasuries are not that good for building wealth. They're sure good for keeping wealth. Stocks are what you buy when you're trying to get rich. You buy treasuries to stay rich. On Mad Money today, Confluent has fallen from its July highs. And with the company kicking off its current conference to lay out the future of data streaming, I'm learning more about what's on the horizon with the company's top brass. Then close viewers know we have been following this never-ending rally in the price of oil, and as investors are searching for a top in the commodity, which would be amazing, I'm going to my expert in the field, RBN Energy's Rusty Brazil, for more. And with Carrier's acquisition of Viessmann marching forward, what synergies exist to create a new climate powerhouse in the reimagined Carrier that is not going to be stopped by the darn 10-year? I'm getting the details of the deal with the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.